China is selling treasuries, not in a sudden collapse, not in a headline panic, but through a steady reduction that is now large enough for global markets to notice. And when one of the largest foreign holders of U.S. government debt steps back, the impact doesn't stay in the bond market. It moves through liquidity, currencies, and ultimately the dollar system itself. The global bond market is now over $100 trillion in size. It is the foundation of modern finance. Pricing for mortgages, corporate borrowing, government deficits, and global risk all anchor to this market. So when demand shifts at the margins, the signal travels everywhere. For years, China accumulated treasuries as a result of its trade surplus with the United States. Export goods, receive dollars, recycle those dollars into U.S. debt. That recycling helped fund U.S. deficits and reinforced the dollar's role at the center of global trade. But that pattern has been changing. China's treasury holdings have trended lower over time, while its gold reserves have been rising. At the same time, bilateral trade with key partners is increasingly being settled in local currencies. These are not isolated policy choices, they are balance sheet adjustments. When a major reserve holder reduces exposure to treasuries, two things matter. First, who replaces that demand? Second, what happens if the replacement demand is weaker or more price-sensitive? The treasury market depends on a constant flow of buyers: foreign central banks, private institutions, domestic funds, and the Federal Reserve. If one large buyer steps back, yields must adjust to attract others. Higher yields tighten financial conditions globally because treasuries are the benchmark for risk-free rates. That means borrowing costs rise, liquidity tightens, and dollar funding becomes more expensive across the global system. This is why a shift in China's treasury strategy is not just a geopolitical story, it is a liquidity story. At the same time, the structure of global reserves is evolving. Central banks are increasing gold purchases at a pace not seen in decades. Gold does not depend on a single issuer. It does not require a clearing network. It functions as a neutral reserve asset in a fragmented monetary environment. So on one side, we see reduced treasury accumulation by a major holder. On the other, we see increased allocation to non-dollar reserve assets and local currency trade settlement. That combination signals diversification away from a single system dependency. This does not mean the dollar is disappearing. The dollar remains the dominant reserve currency and the deepest liquidity pool in the world. U.S. Treasuries are still the most widely held sovereign debt instrument. But global systems change through marginal adjustments, not sudden replacement. If foreign official demand for treasuries grows more slowly while U.S. issuance continues to expand, the gap must be filled domestically or by higher yields. Both paths have consequences. Domestic absorption increases financial system exposure. Higher yields increase debt servicing costs and tighten global liquidity. And because the bond market sits at the core of financial pricing, these shifts propagate outward into equities, currencies, and credit markets. What we are watching is not a single country selling bonds. We are watching the gradual rebalancing of reserve strategy in a world where trade patterns, payment systems, and geopolitical alignments are changing. A $100 trillion market does not move quickly, but when it does adjust, it reshapes the cost of money everywhere. The key question is not whether China holds more or fewer treasuries in any single month. The key question is whether the long-term trend of reserve diversification continues and whether new buyers are willing to absorb expanding U.S. issuance without higher compensation. Because the dollar system relies on continuous external demand for its debt to maintain stability. If that demand becomes more fragmented, the signal will first appear in yields, then in liquidity, and eventually in the structure of global capital flows. The bond market is where those signals emerge first. and right now it is beginning to react.